at that table to munch on. And so I'm so excited, I try to, strategically plan these classes with the time that we're dealing with. And so, next month on the 15th is that big old tax day. And so, what better topic tonight to talk about than our taxes and tax forms? Because a lot of times, I showed up. Man, I was down in their office about 2 or 3 weeks ago with one of their accountants, and I'm just telling you what, I just don't even want to think about it. I don't even want to deal with it. I just rather have somebody that deals with it and let them do it. They are the experts, and so let them handle it. So I'm so excited to introduce my friend. We got we're twofold. We're in Rotary together, and so I said, you know what? And when I was thinking, I said, who can I get? Now I just got somebody that I can just call on. Hey, how you doing? I said, whenever I call, I just like to say yes, 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 yes. And so I'm just so excited to introduce Miss Amy Hightower, accountant. She works with the first CRI right there in the corner, second and love, and she's gonna just talk to us a little bit tonight about stuff. Get your papers. Y'all know, I said, we love handouts over here. We love handouts, so hey, we got plenty of handouts, so get your handouts, it's stuff for you to write on. You got plenty of space to write, so listen, now listen, I didn't do door prizes tonight for a reason. Okay? All right, so there you go. Don't just turn it over to you so have your place. Oh, no, you don't. Did everybody see me? Y'all got it? And if you didn't sign in, I'll get you before you leave.
Amen.
Before you leave. Okay, but you know I get the door prize. You didn't have to go with me. Yeah. I need to follow down there, Bob. It is. Here. Take me a little ahead of me.
Okay. I'm going to be doing this all day because I cannot see this, but I can see y'all clear. So, as Ms. Tanya said, my name's Amy Hightower. I'm a CPA here in town. I've been practicing for, I think this is my 26th year. And she seems very excited about taxes, but she's probably the only one in the room that's talking about taxes. So I'll try to make it light, but no one really excited too much about taxes, especially for me, not this time of year. Feel free to stop me at any point in time. If you have a question, raise your hand, shout out, Amy, stop me, I got a question there. I know it's a lot easier to remember the question right then versus further down the road. And if you can't hear me, I've declined the mic, but I feel like I'm usually pretty loud. And so I don't know that I need the mic, but if you can't hear me, let me know, please. So, in the words of the great Dr. Seuss, congratulations, today is your day. You're off to pay your taxes. You got money to pay. You have cash in the bank, but hold on tightly because things will get worse. You're on your own and you know what you got to do. And you're in big trouble without a tax break. Now, I would disagree. This was pretty funny. I was just trying to find something to lighten the mood. This is actually a Dr. Seuss poem that's about 10 pages long. So we're not covering all that. And I would say you don't necessarily need a tax pro, but the lesson here, I would say, is that you do need to understand your taxes even if someone else is doing your return for you. It's important because ultimately, it's your responsibility to file a correct return. I know it hasn't been, probably within the last 2 weeks, I saw something posted on Tips and Talks on Facebook about some incorrect tax return that was filed and they didn't know it until they went and, someone told them just to sign here and they signed there. And then all of a sudden they pulled up transcripts and come to find out there's these things on their tax return that they did not realize were on there. Shame, shame, shame on whoever prepared that return. That was wrong and illegal. But also a little bit of shame of whoever did look at their tax return. Because the ultimate lesson here is at the end of the day, it is your tax return. And whether or not you have someone prepare it for you or you prepare it yourself, you need to know what's on the return. I love for my clients to look over their return. Because I may have misunderstood something that they gave me. I may not keep up with them. They may have had a child move out of the home. They may have had a new child and be what you're calculating on your tax return. But I also want you to understand, everyone here that has a job that's a W-2. We got W-2 jobs. So I'm going to talk about Social Security, Medicare, make sure that you understand how that works. And then just understand that there's some other taxes that for some certain people it's calculated on the tax return, such as the net investment tax, the Medicare surtax. Anytime the word surtax is used, that's sort of scary. And there's the alternative minimum tax. Many of you may not know this, but the tax system is twofold. When you do your tax return, how many of you do your own tax returns? We've got one. We have several. Okay. When you're preparing your tax return, there's a system. I call the tax system is dual-fold. And if you're using a software, there's a system and you get a calculation. There's another calculation going on that you don't know anything about. And for a majority of Americans, it doesn't impact anybody. But it's called the alternative minimum tax. And it's like, hey, for system A, you can add this and subtract this. But in system B, you can't do that. And system B may come up with a higher number. And if system B comes up with a higher number, guess what one you're going to have is the higher number. So there's a lot of different taxes and it's very complex. For a majority of Americans, alternative minimum tax doesn't apply, but I always like to let people know that there's a lot of things going on with that software that you might not know about. Social Security, Medicare. If you're an employee, I want you to understand that in Social Security, Medicare, up to a certain threshold, you are paying in 6.2% into the Social Security system. Your employer is also putting in that same amount into the Social Security system for you. You're putting in Medicare 1.5% into the system. That's coming out of your paycheck. And your employer is also putting that into the system. So if you're self-employed, that calculation changes, and it also shows up on your tax return. Now, if you're an employee and you get a W-2, Social Security Medicare really doesn't impact your tax return. That's already been calculated, it's been taken out of your paycheck, it's reflected on your W-2. So your W-2, you have a box 1, wages, box 2 is federal withholdings, box 3 is Social Security wages, box 4 is the Social Security tax that your employer took out of your paycheck on those Social Security wages. Box 5 is Medicare wages. And box 6 is the Medicare tax your employer took out. So usually when you file your tax return and you submit your W-2 with your tax return or you give it to your tax preparer, what the tax return is actually just calculating is federal income tax. It's looking at your box 1 wages and any other income you have, and it's saying, it's spitting out a number that says you owe $5,000. And then it's going to say, and you had $6,000 withheld from your paycheck. That's your box 2 of your W-2. So you're going to get a refund of that. So in simple numbers, if you just got a W-2, that's what happens. But there's a lot of other taxes, and we're not going to go into detail on business owners that are self-employed, but know that Social Security, Medicare, if you're self-employed or have any type of self-employed business, we're talking about, if you've got a yard, lawn mowing business, or if you work or you get paid somehow not on the W-2, then those taxes actually do come into play on your tax return when you're working on your tax return. Questions so far? I'm just trying to be funny. Okay, so this is sort of a laundry list of what I want to go over today. First, we're going to start with current tax laws and changes. And the reason that's important is because this is going to be a big tax year change. Not 2024 when you're filing your tax return. 2024, you're good. But 2025, the end of 2025, we're going to have tax law changes. Now, the majority of those may not be into play until January 1st of 2026. But we're going to hear a lot in the news. We're already hearing a lot in the news. But we're going to hear a lot in the news, and there are going to be concrete changes. So let's talk about why we're going to have changes. The current tax law, at least when I talk about tax law, there's the things that never change. We always have an income tax rate. That doesn't change. We're going to have graduated rates, the top tax bracket. We always have different tax rates. Those never change. But the top rate may change. The number may change. The tax laws numbers change every year. So as an accountant, I don't try to remember those changes, they change every year. I have big books. And not only big books, but y'all have a one sheet. I'm gonna call this a one sheet. Those are the numbers for this year. And these are numbers that I don't try to remember. I like to keep this really handy, so if a client calls me and asks me a question, I can quickly pull out this one sheet and say, well, if you look on the right hand of this one sheet, those are the tax tables. And if you look at the bottom of those tax tables, it shows a percentage of 37%. That's the current top tax rate for an individual, okay? That is something that is set to expire at the end of 2025. And that could change. It may not change, but it could change. But the point is that the majority of the tax laws that we're dealing with now came about from the 2017 Tax Cuts and Jobs Act. And the way that worked was all of those rules were going to expire at the end of 2025. So if Congress does nothing, if we absolutely do nothing, then that 37% rate is going to go back up to 39.6%. The standard deduction, which we'll explain what that is later, right now the standard deduction is, I believe this is on this cheat sheet too, it's on the back side of the cheat sheet. Let's find it over cheat sheet. The standard deduction is around $29,000. I don't see it right now on the cheat sheet, but it's going to cut in half. If Congress does nothing, all of these tax laws expire and they revert back to what they were before 2017. And so the standard deduction is around $29,000, it would be cut in half to $14,000, whatever changes. So there's going to be changes. I don't see a lot of this reverting back. I don't see us going backwards. But that's going to take an act of Congress and a tax law to be passed so that we don't go backwards. So we're going to see a lot of changes. So you hear in the news about changes. What's some of the hot topics you hear now are Social Security. You hear about tips for those working in the restaurant industry. And you also hear about federal income tax being repealed. So let me just tell you my thoughts on these. I think it would be awesome if Social Security was not taxed. That is a common misconception. I often hear, I have clients call me, and they ask, well, my Social Security is not taxable. And I'm like, well, it depends. You know, it's a calculation, and depending on how much other income you have. If you only have Social Security income, you don't need to file a tax return, and you're not going to pay any tax. But if you have other sources of income, it could be taxable. It's on this little sliding scale. But a lot of people are under the misconception that it's not taxable. It is currently up to 85%, and it's not taxable to the state of Georgia. Okay. So I think it would be wonderful if it was repealed. You know, you earned that money, you paid it in on your W-2. You know, there's an argument both ways, but I could see this having support among both sides of this issue. Tips. We hear about tips, and that sounds like a great thing. I don't know how that's going to play out. I personally, you know, from a tax standpoint, I sit back and say someone that's working in the restaurant industry, that is part of their wages. They should pay tax. So that's me from a tax standpoint. And so I don't know what that's going to play out, but that's one sort of the hot topics that you were hearing on both sides. I don't see the federal income tax law. I just don't see. That's been thrown out left and right for many, many years, and I've been here 26 years. Let it hang on for a few more years. I'll be good till I can retire. But that's what we're going into for 2025, is we're going to hear a lot about taxes in the news. Because we've got to have tax changes. Questions? Yes, ma'am.
Okay, you said tips for the waitress and waiters. Okay, so wouldn't that be like catch-22? Because if I leave a 10 spot on the table for that person, so how would that be? How would you pay taxes out of that if it's just cash?
So, does anybody work in the restaurant industry? Okay, we got one. So, minimum wage, and I'm not even sure where minimum wage is at right now. But happening. So, you know, the employer is saying, hey, I only have to pay you $2 to $3 an hour. That's the restaurant minimum wage. But you have to make full minimum wage. If you don't, I've got to pay as a restaurant owner the difference. Is that clear?
They pay it to the employee?
They'd have to pay, if I was working in a restaurant and I only said, hey, I only made $4 an hour after my tips, the employer would have to pay you more to get me to minimum wage. But then you also have to step back there, and if I'm the employer, I would be saying, okay, let's evaluate why you didn't make but $4 an hour in tips. Are you a bad employee? Are we just not busy? Which is this is a whole nother. These are issues. These are not tax issues. These are more of a management issue in the business. You know, why are you not making minimum wage? So we're going to step back and just talk about some tax terminology here. So here's some common forms. Everyone's familiar with the W-2. That's going to report, you know, if you're an employee, that's going to report your wages. Another common form is a 1099 INT. So if you got a bank account that's earning a little bit of interest, that's going to show the interest that you report. There's a 1098-T. So if you're in college, or if you have a child in college, that 1098-T is going to report the tuition that if you paid anything out of pocket, that's going to report the tuition that you paid out of pocket related to that child in college. And that's important because you may be eligible for some type of education credit. And I use the word credit, and I'm going to define credit in a little bit, okay? A 1095 reports your health insurance coverage. There's a lot of confusion over this because these rules came out, oh gosh, I don't remember when these rules came out. But at one time, everyone was required to have health insurance. And they were required to prove that they had health insurance. And that was a 1095. And so I still get those forms from my clients saying, hey, or my clients are saying, hey, I haven't received my 1095. And I'm like, oh, I don't care. And they're looking at me like, well, you seem very lackadaisy about this. And I'm like, I don't need that information anymore. It's not my job to report whether or not you have insurance anymore. At one time, it was my job, but now it's not. But what is important about 1095 is if you purchased insurance through the marketplace, if your health insurance came through the marketplace, and you got a credit based off when you go to the marketplace and get insurance, you tell the marketplace what you think your income's going to be. And based on that income, they determine how much you're going to pay for the insurance and how much advance credit they're going to give you. So basically, if the premium should be $500, they may say, well, you're only going to pay $300 and we're going to pay the other $200, okay? There is a 1095 form, 1095A that comes out that reconciles that, and it says for the year, these are the people that are on the marketplace insurance. This is how much the premiums were. This is how much the taxpayer paid. You have to reconcile that on your tax return. If you don't reconcile that on your tax return, I will guarantee you will get a notice. So that's why this form's up there and why it's important. And then the 1098 form is where you pay mortgage interest if you have a house and you pay mortgage interest on the home. And that is important because that can be a deduction on your tax return. And again, I've used the word deductions, I've used the word credits, and I'm going to define those in a moment so we understand how those work in tax returns.
Got some questions?
Yes, ma'am.
Go back to the 1095.
Yes, ma'am.
Okay, I filed my taxes this year and I had insurance through the marketplace all year.
Okay.
So I go to file my taxes and they pulled up, the insurance, I had to have that form, right?
Right.
So I give it to my tax, preparer, and all of a sudden, it got me to where I'm having to pay me. And then, not only that, they was afraid to cancel my insurance because they wanted me to pay the double amount of insurance. If I was paying
Yep.
$80 or $90, then the following month, they wanted me to pay $200 or $300.
Whoa.
Why?
Good question. And I see that happen. That's why I caution people. I have a lot of clients that have insurance in the marketplace and they're self-employed, meaning their income goes up and down, up and down. And so what happens is when you went to the marketplace, they asked for your income and you gave them a number. And so again, that's what I said, you have to reconcile The marketplace gave you that advance payment based on the income that you told them. Now it has to be reconciled on the tax return, and the income on your tax return is different. And so they're saying, okay, well, at this level of income, you were due this credit. At this level of income, what you do is a lower level of credit. And so therefore you got to pay back the difference. And so then you got, so that's part one why you're owing on return. And then part two is now you got to go back to the marketplace and look at, was 2024, was something different in 2024 that made your income higher than 2023? And if that's the case, you need to go to the marketplace in 2025 and say, hey, my income's not going to be what it was in 2024. This is what it's going to be. But even if right now you're paying a higher premium on your insurance because they're basing it off the 2024 numbers, which were higher. But you could go up front and tell the marketplace a different number, and hopefully that will lower it. Or it could flip out when you do your 2025 return, and your income was down for actual 2025, then you would get a refund. Because again, we reconcile again, and we say in 2025, your income is here, and I'm due this credit, but I only got this much credit in 2025 in advance. And so the tax return would actually pay you the difference. Does that explain that? It doesn't.
I have a question.
Yes, ma'am.
You said the 1098T. Last year, I had a child in college,
Okay.
got a 1098T. We did this one this year.
Good question. I'm glad you mentioned that because I almost forgot to tell you that. I've never seen a 1098T mailed. So what that 1098 usually resides in the child's college account. If they log into their account wherever they're at in college, into their student account, they can pull that form. I've never seen one mailed. I always have to get that form, and there's another form I always have to tell my clients, you're going to have to go log into this account and pull it. Yes, ma'am.
I had, filed my taxes and they, the IRS contacted me saying that I needed to send them a 1095. But for the year that they were talking about, I didn't have
You didn't have
marketplace
a
insurance.
1095, but
No.
something in their system is showing that you did. So I would contact the marketplace to see if they're showing something.
How are you gonna contact them? They won't answer the phone.
Amen. I completely agree with you. It's a problem. I have seen the solution I have done on a tax return on that is I have, what you should do is potentially set up an account with the IRS to see if you can, and set up an account with the marketplace to see if you can pull it online.
They just told me that, my return could be lowered if I didn't produce it. But I can't produce something I don't have. I've been in the marketplace trying to locate it. It doesn't exist.
It doesn't exist.
Wow.
But they didn't hold your refund up.
Yeah, they held it up.
They've still got your refund.
Yeah.
Is it-
I just sent the information in and, they finally sent me another letter and told me what to do. And I did that, and so,
The next step I would say is there's a department called the Taxpayers Advocate Department. Taxpayers Advocate are IRS agents that are out there, but their intent is to help us in the room. They're not to be acting as IRS agents, they are here to help us as taxpayers. And that is where I would go next with that. I hear your frustrations, I see those incorrect sometimes for the marketplace, sometimes depending. Sometimes I've had the form, but I've had a client bring me the form and tell me the form is wrong, and we can't get it corrected in the marketplace. I can do things on my software to at least still get the IRS the form, but make it work out. But for you don't even have the form, so that's the
how can
problem.
you unsign up for that?
Unsign up for that?
Yes.
So you don't get on insurance through the marketplace anymore? Do you get insurance still through the marketplace?
I never needed it. I have it through my job.
Yeah. Someone could have signed up under your name.
Oh.
Yeah. Yeah, that would be, that's why I would contact Taxpayers Advocacy, because if you're dealing with identity theft or the potential identity theft, you're gonna get more of a response from them when you have a case like that.
Okay.
Taxpayers Advocacy Service.
Thank you.
Yeah, just be trying to. I'm gonna say this, the IRS doesn't care how you earn the money. They want the money. You know, they're not the government, they're not law enforcement, they just want their money. The funniest story I tell is now it's more widespread, but in states that marijuana is legal in, marijuana, again, we're getting a little bit further along, but marijuana is a cash business, okay? Because the money can't go through the bank. In states that marijuana is legal in, there are actually IRS collection centers that are there, that they bring their tax money to be paid in cash.
Wow.
So, IRS doesn't care how you earn the money, they want you to put it in gross income. You know, now if I sit here and said, I'd like to have your chicken, and you're gonna ask me, what do I have in exchange to give you? That's a transaction that may be gross income. That's barter. Now, I've never seen that in practice, but it exists. Bartering is gross income. So you've got some adjustments that you can make, such as educator expenses, retirement contributions, student loan interest. You get to adjusted gross income. Adjusted gross income is the number that's often asked on FAFSA forms for college. You know, if you're going, yes, ma'am.
I have a question on that, the first home we say give you from school,
Uh-huh.
it was like last year I paid around like 8,000 on my tuition. And when I was filing my taxes, I put it there, they gave me like 1,000 back.
Yeah.
And then,
You don't get it, that's a credit. It's not a dollar for dollar credit. That's a credit. You're not gonna get 8,000 back.
so how do they calculate?
We'll talk about that in a minute. Adjusted gross income is the number often used for FAFSA forms. They ask for it if maybe you have medical bills in the hospital or something and you need help. A lot of people are asking for your adjusted gross income. So be familiar with that number. It's easy to find on the tax return. And then after adjusted gross income, you have either the standard deductions or itemized deductions. That's the number the IRS gives you, or at least the standard deduction is. Itemized deduction is an option you can take, and we're going to talk about that in a minute. But you can take one or the other, and then it's going to reduce your adjusted gross income and get you your taxable income. And then you take your taxable income times your tax rate, and you come up with your tax. Now, let's talk about your tax and what your tax rate is. In this little quick sheet on the right side on the front page where it says 1040 Quick Finder, the first little grid up here on the top right, it says MFJ. That's Mary Filing Journal. Okay? And so you see here that the first $23,000 of your income is taxed at 10%. Does everybody see where I'm getting the 10%? That's not your gross income that we're taxing. It's your taxable income, okay? So we got some deductions there. Your first is taxed at 10%. That is what we call the marginal tax rate. You're in the 10% marginal tax rate. So if you had income of, let's say, 100,000, taxable income of 100,000, and you're married filing jointly, that puts you in the numbers between 94 and 200, okay? That means your marginal tax rate is 22%. But that is not your overall tax. You did not pay 22% on every $100,000. You paid 10% on the first 23,000, and then for 23 to 94, you paid 12%. And then for that over 94, you pay 22%. So you're in the top marginal tax rate of 22%. But what you have to do is you literally take your tax divided by your adjusted gross income, and you come up with your average tax rate. So in my world, I use the words marginal tax rate and average tax rate. You know, clients are a lot happier when I tell them, instead of them being in the 22% bracket, I say, well, on average, you pay 15%. And they're like, that's pretty good. So, but both of them are really important. You know, from a planning standpoint, I try to, if I'm working with clients and we're planning, I look at these numbers and I'm like, well, you know, if we spend a few more dollars in your business, we can get you out of the 22% bracket. So that's what I use from a planning standpoint. But that's to understand the difference between marginal tax rate and average tax rate. And it's a common misconception that everyone believes that all their income is taxed at the same rate. It's not. It's a graduated rate system as in that level of income, you pay a different rate. Now, who knows what the lowest tax rate is? Absolutely. There is a 0% tax rate. There is a 0% tax rate for capital gains. And it exists if you're in the bracket, if your income does not, for a married filing joint couple, if your income doesn't exceed $94,000 and you had some capital gains during that year, it's going to be taxed at 0%. It's a beauty. It's a beautiful thing to be able to tell clients, well, you know, they sold mom and dad's house, or they sold a piece of land that mom and dad had, or something, and there's no tax on it. So, but that's absolutely right. So we calculated our tax. Then we're going to compare our tax on the tax return to what we paid in through our W-2, or then we may have paid in other ways. And that's going to be our refund or balance due. And there could be some credits. So right here, you see I've got credits on the same line as taxes. And we've talked about deductions. A deduction reduces my income. So, you know, if I had $10,000 in income and I had $5,000 in student loan interest, though there's a cap on that, maybe my taxable income's only $5,000. A credit is almost like someone gave you $1. But they're not always dollar for dollar. But a credit, your education is an education credit. There's a child care credit if you have someone that's taking care of your children while you are working. There's the child tax credit, just having a child. Those are dollar for dollar to offset your taxes. So if you had a $5,000 tax liability, your credit's going to offset that dollar for dollar to the extent that the limit of that credit. And every credit has a different limit. So the child tax credit is $2,000 per person is the max per child. And the education credit, I think, is a max of $2,500, and it's two-tier. First, you get 20% up to a certain amount. I think you can't use the whole $8,000. There's a certain amount, you only get 20% of that. And that's why you only got $1,000, because it's a multiple calculation. And some of it's refundable, and some of it's not, which could also be the issue. So when I talk about a refundable credit, let's say my tax was 0, but I've got one child. Well, that seems to me to say I should get a $2,000 refund, because that's a credit. Well, only part of that credit is refundable. So refundable means you're not going to get the credit. Refundable means you'll get the credit even if you had no tax. And when I say I have no tax, I'm talking about taxable income times my tax rate. I'm not talking about refund, okay? Refund comes down a little bit later. A non-refundable credit says, hey, I can offset any tax you have, but outside of that, I'm not giving you any money back, okay? So that's refundable versus non-refundable. Let's talk about standard deduction. We talked about credits. We talked about deductions. Standard deduction versus itemized deduction. So the IRS right now, if you're single, you get a standard deduction of $14,600. If you're married filing jointly, you get $29,200. So again, we look at our calculation, gross income, less maybe we have student loan interest, maybe we have educator expenses or something else, we've got some deductions, we get to adjusted gross income. Then we're at a stopping point, and we got to figure out which way we're going to go. Are we going to take the standard deduction the IRS gives us? Or are we going to take what's behind door number 2? Now door number 2 we got to calculate, and we got to figure it out ourselves. But sometimes door number 2 is a bigger number, and if it's a bigger number, we want to do that. And door number 2 is really 3 buckets. It's state and local income taxes, medical expenses, 4 buckets, mortgage, interest, and charitable donations. For most of my clients, I'll ask them, do you have a mortgage on your home? If they tell me no, I'm going to tell them probably they can't take it. They're not going to itemize. Now, I may have some that are extremely charitable, and that's an exception. But in general, you know, when I ask for, you know, if I have a young married couple coming in the door, and they're raising their family, and they're new, and they don't have a mortgage yet, maybe they're renting, I can probably say with accuracy 99.9% of the time they can't have it. Yes, ma'am.
So the charitable contributions, like with your tithe and church. So, you know, what would you consider, I know you just
A good number, what are we trying to accomplish with this number?
What's the most you can give in charitable
Do what?
donation? What's the most you can give in a charitable donation that would be eligible for your?
That's my discussion. I mean, because, you know, there was a law, I thought that there was a tax law that was passed, and so I just kind of stopped, I backed off on some of my giving. I said, well, it's not gonna have an impact, I'm just gonna drop.
Okay, well, assuming we're single, and we've got a standard deduction of $14,600, and assuming that we don't have a mortgage, and that we don't have medical expenses, because there's a whole other calculation that's gotta happen on medical expenses, then you're gonna need more than $14,000 in charitable deduction, because you want to exceed that number. So if you had, let's say you had a salary of $40,000, okay? State tax rate's about 5%, so let's say you had $2,000 in state taxes. I'm single, I make $40,000, I paid in $2,000 in state taxes. Maybe I have a house or something that I paid some property taxes on, some real estate taxes, so let's just say it's another $1,000. I've got $2,000 in income taxes I paid the state of Georgia on my W-2. I got $1,000 in property taxes, I'm up to $3,000, okay? I still need $11,600 in charitable donations for me to exceed the $14,600. So that's something you gotta look at. Because, I mean, the government's giving me this, so I'm gonna, now, and that's the single. If you're married, you got $29,000. Now, there are ways around that. Let's just say, this is where it gets a little complex, but let's just say I said you needed $11,600. Well, let's just say you normally give $7,000. Well, it's not at the $11,600, but this is what in my world, I tell my clients, and they don't like it, but I tell them, okay, I want you to get 14 one year, nothing the next year. Well, then, 1 year, I got $14,000 in donations. I got $2,000 in taxes from my wages, and $1,000 in my property taxes. I got 14, 15, 16, 17, I'm bigger. So 1 year I do 17, the next year, 1 year I itemize, I go to door number B. Next year I come back to door number A. But a lot of clients don't like to do that, because those that are tithing, they don't want to disrupt the flow of funds to the charity they're trying to support. But it can be done to get there. Limitation. There is no limit other than the IRS says you can't deduct more than 50% of your adjusted gross income. So if we go back, look at adjusted gross income. Whatever that number is, 50% of that's going to be the limit for that year. You don't lose it. So if you gain more than that and you're itemizing, you don't lose what you don't deduct. It carries forward. But that's the general limit. And that's for just cash donations. It gets a little quirky if we talk about other donations.
So if you went over 1 year, say you went over 1 year, you're saying like you're doing like 50%, so you give 50% this year, you can hold that other 50% and give it the following year?
No, you gave, let's just say let's say your adjusted gross income was 40, and you gave 30 this year. Well, you're going to be able to take 20 on the tax return, and the other 10 carries forward. You gave the whole 30, but the other 10 carries forward.
Okay.
Yeah. But you got to get through a lot of hurdles. Adjusting gross income is one hurdle, but we also got to, we're sticking with door number A unless door number B comes up to be a bigger number. We got to add all this up. And in most cases, unless there's a mortgage around, door number B doesn't make sense. Questions? Just briefly want to touch on Hurricane Helene. So, hurricanes come about, one, the deadline technically this year is May the 1st. more of a cash economy. It's not what something is worth. You know, it's just like someone mentioned stocks earlier. And, you know, if you have a stock and you pay $5 for a stock and it goes up to $100, you've got a $95 profit. You're not going to pay tax on that until you sell that stock and get $100 in cash in your hand. Now, in the same stock, let's say you pay $100 for the stock and it goes down to $5 and you've lost $95. I'm sorry you lost $95, but you know what your loss is that you can take when you sell that stock? The $5 you paid for it. And so, and I hate it for hurricane, those that have damage with hurricane, but that's a common misconception, is they're coming to me and they're saying, I've lost this, insurance doesn't replace it, and this is what I think was what it was worth. And I'm so sorry, but let's talk about what you paid for it. And that's obviously a much lower number and a different number. But the deadline's May the 1st. Identity theft in the IRS. Just a couple of points here. You know, if you think you've been a victim of identity theft, there's a form that you can fill out with the IRS. It's 14039. It's a very quick form. But typically what that sort of kicks off with the IRS is the IRS will issue you a PIN number. And a PIN number is an additional number needed to file your tax return. You know, obviously you need your Social Security number on your tax return, but there's another number on the form called a PIN number, and no one can file that tax return without the PIN number. And so, you know, if you're a victim of identity theft, you may want to, you know, report it to the IRS. They don't always assign a PIN number. I will tell you that, does anybody in here have a PIN number? We have some people that have a PIN number. Do you get your PIN number every year, or do you have to chase it down? Chase it down. Perfect. And you can also opt out. So, yeah. Do what? You can opt. I opted out with a client. So we have one client that his name and his child's name is the exact same. One's a third, one's a junior. And so a PIN number would come, and we don't know whose we have. It's just like playing Russian roulette to figure out which way to go. And 1 year he did it, 1 year we didn't. So we opted out. We got online to pull it. And I started digging around. I was like, oh, look, there's this opt out. I looked at my client and I said, would you like to opt out? I made his day. Something so simple to opt out. Because we're not even really sure. He did not have identity theft that was tied to his son. And so he was tickled to opt out. But, you know, if you're not familiar with them, you can request one. Two, I don't see a consistency in them showing up. This is not a one-time PIN. This is a PIN that you get every year. So you should be getting a letter every January or thereabouts for your new number. And the PIN is based off of the year that you're in. So for my client, we were filing his 2023 return, because they're not due until May 1st also. So you would think that I needed the 2024 PIN that came in the mail during 2024. No, I'm using the 2025 PIN that came in the mail during 2025, because that's when I'm actually filing this tax return. So they're a little bit aggravating, but if you've had identity theft, I definitely would recommend getting them. You know, so, you know, talk about what do you need to do if you, you know, feel like you've been scammed. You know, the IRS has got a great webpage, and they talk about, you know, file a police report, check your credit. Make sure have y'all had a class on credit? Go to the major credit reporting companies and check your credit and flag them. You know, report to the IRS. There's also a website called identitytheft.gov. That's not the IRS, that's another government website. So you can report potential identity theft there too. Do you have to file a tax return? Well, here are the filing thresholds depending on your filing status. Single, head of household, married filing jointly. And if you notice, 14,600, 29,200 for married filing jointly, those are the standard, that's the standard deduction for those years. this talks about gross income. If you're over 65, the gross income calculation is a little bit differently because you got to figure out whether or not you're going to include Social Security in that number. And so, I always have to look it up. A client will call me, and then I have several clients that they're on the borderline. They might need to file or might not need to file. And I tell them, y'all just call me every year. Tell me what income you have, and let's look it up and do the calculation. So to see if you need to file. Because you may not include, you're never going to include more than 85% of your Social Security, but you may not even include any of your Social Security in the gross income calculation to determine whether or not you need to file. But if you're a child, you should file if you have earned income over $1,300 or more than $14,000 in earned income. So earned income is going to be your wages. So if you're a dependent, if you're a child, and they're working, if they have more than $14,600 in earned income, they need to file. But if they have more than $1,300 in unearned income, they need to file. That's a much lower number. Unearned income is going to be income from the stock markets, if they have stock market investments. It's going to be interest or dividends or things like that. Maybe someone left them some money, they've earned some interest and dividends. So it's a lot lower threshold for unearned income. If you have a child that's working, they're under 18, and they're working somewhere, my recommendation, if they're not going to make $14,000, is to make sure that their employer is not withholding any federal income tax. Okay? Because if someone, let's say we got a child, high school, college, whatever, they're working, they're your dependent, and they made $8,000, but their employer took $500 in federal income tax. They're going to have to, they were not required to file a tax return because they made under $14,600. But they're going to have to file a tax return to get that money back. But if they don't have any tax repelled, no one would ever have to file a tax return. We're all good. The IRS is not mad at you, and you got all the money that was your money. And if you file your own tax returns, it might not be a big deal. But still, these online filing systems still charge something for the software most of them. So anyway, just something to think of. I run into that a lot with clients is that they'll bring me their child's W-2, and I said, look, they have $50 withheld. It's going to cost you more than $50 for me to do the tax return. My recommendation is do nothing for this year, and next year you go talk to your child and you make sure that they don't have any withholding. So let's talk about IRS scams and how the IRS communicates with you. Well, as we talked about earlier, they don't communicate with us. I see that, and unfortunately I see that on my end. It's honest to God's truth, it's a little bit better now, but a year ago, if I did not call the IRS by 8:30, their system said that they were too busy to take my call and try again. Wow. And I have a different number than y'all have. I mean, there is a tax practitioner number that's dedicated for tax practitioners, and still by 8:30, I was told, try again another day. So it's very frustrating. I understand that. But this time of year, scams are heightened. There's a lot more going on. The IRS is not going to email or text you unless they've talked to you about that and said that. I deal with IRS agents right now, and I've got a tax audit going on. We will email, but it's more of a, hey, can I have 2 more days to get this to you? It's not a lot of detailed client information or taxpayer information. It's very limited. But that was only after we had a discussion and we knew that's how we were going to communicate. They will call you, an upfront call. You're going to get a call. They're not going to leave a robocall that says, you need to pay your taxes by tomorrow. That's a scam. So just recognize, I would say 99% of the time, if you've gotten anybody that's reached out to you and said that you have past due taxes, you need to call, it's a scam. I would just suggest you call the IRS yourself, or as this young lady says, she's got an online account. That's the best thing you could possibly do is set up an online account with the IRS, and that way you can see your information yourself. That account, like she was indicating, she could get her PIN number out of her account for filing her tax return. I can have an account and see your information, but that's the piece that I can't see. So when I went and worked with my client to get his PIN number online, we had to sit down in a room together with my computer, and he had to do everything, and I just sort of $5,000 back. Or again, demands and threats. These are all scams. You know, again, if the IRS needed you, one, how did they get your number? Did you put your number on the tax return? You know, because trust me, their computer system is not sophisticated. So first of all, I'm going to ask how did they get your number, especially if they're calling yourself low. So just, I would say 99% on this fake. But just be careful.
I have a question.
Yes, ma'am.
I want to go back to where you said dependent children.
Uh-huh.
Up to what age can you pay?
It just depends. The normal age is 18, but if they're a full-time student, 18 up to 23, I think. Full-time student. And there's differences to know that there is a dependent child that meets a certain test. There's a relationship test that your child or your grandchild or something, there's a dependent child. And then there's just a dependent. So I can have someone completely unrelated to me, living with me, and I'm supporting them, and they don't have no more than a certain level of income, and they're my dependent. But that's different from a dependent child. So what happens if you don't file a tax return? The biggest thing I say about not filing a tax return, I have a lot of clients, I've got a young kid now, he hasn't filed in 4 years. He's like, I just hadn't been in a hurry about it. Well, guess what? IRS hadn't contacted him. And you know why? Because they didn't think he owed. And you know what happens when you don't owe the IRS and you don't file a tax return? The IRS keeps your money.
I'll do that again. They do what?
The IRS keeps your money. So let's just say 4 years ago, you worked and you had a $20,000 W-2 and you knew you had plenty of taxes withheld and you just hadn't gotten around to filing it. Well, after 3 years from the day that should have been filed, so if, let's just say the tax year was 2020, then that should have been filed April 15th, 2021 to 2 to 3 to 4. We're past 3 years, that's the IRS's money. It doesn't matter if you were doing a refund. Now, on the flip side, if you didn't file a return and you owe the IRS money, there's no statute to run. You know, the IRS will collect that whenever they want to. In fact, they'll do a couple of things if you don't file a tax return. One, they may file a substitute tax return for you. Based on what they know, they will go in and file a tax return. Now, for those of us that just have a W-2, we're employed and we work for someone, that's not a big deal, okay? But if we're self-employed and we get income that's reported to us on a 1099 because we have our own business, this is a problem. Because all the IRS has is the income for your business. They don't have the expenses. So you can imagine what that tax return looks like. Let's just say you've seen something like that. It's not a big deal. So it's important to file your tax returns because again, there's no statute. It can only hurt you. There's no statute for when they can file if you've never filed. They can come back. Now, in practical matters, I don't think their system goes back more than 5 years. I don't think they can see it. But you're going to lose out if you would do a refund, and they can always come back after you if they file a substitute return. Now again, I don't see substitute returns filed for those that are just employed. It's usually more of a self-employed because they see all this income and they don't see any expenses. Yes, ma'am.
I have a question. Okay, at my job, I'm self-employed.
Okay.
They do not tax me, but at the end of the year, they say I have to file because they be already reported the income.
They report the income.
And they give me a 1099. So why, if they paying on the,
No, they had to file a 1099. It's their requirement to file a 1099 to tell the IRS they paid you.
right,
And really, mainly they're doing that so that the IRS knows that you got paid. So the IRS is looking for your return. But you do, I mean, you have to file. You don't have to file, but you're gonna be better off to file because you probably have some expenses. You got some expenses, and the IRS doesn't know about it. So if you do nothing, you're gonna get a substitute tax return.
That keeps them out of trouble.
Do what?
That keeps them out of trouble.
It keeps them out of trouble. They're required to report who they pay. So a lot of the IRS, interest or penalties are based off the tax you owe. What if you can't pay your taxes? The IRS is actually fairly easy to work with if you can't pay your taxes. First of all, it's important to understand why you owe, and I'm going to talk about that a little bit because this is a common issue I see with clients. But it's also important to understand what the IRS's expectations are of you paying. They want their money during the year. They don't want it on April 15th. Okay? And there's a couple of rules. One is that you pay me as much as you paid me again last year. Usually, if we work, let's just say I have a job and I make $40,000 a year. And year one, everything was rocking and rolling, so I just had them withhold taxes, and all was great. And I filed my tax return, and I got a refund. Let's just say my tax was $4,000, and I withheld $4,500, I got a $500 refund. Okay, that was year one. Year two rolled around, and I was having some financial difficulties. And at $40,000, I just asked my employer, please don't withhold any taxes. Okay? And my employer didn't withhold anything. So really, on my tax return, my income did change, $40,000 both years. But what did change, it becomes the bottom line, is that I owe $4,000 and I didn't pay anything. The IRS isn't going to like that. They're going to charge you interest and penalties because you didn't pay them during the year. Okay? So, and there's a couple of rules for that. And so you want to, make sure, and if you owe them money and you have to work out an agreement with them to get it paid, which is fine, they're usually easy to work at with. One of the first things they're going to ask you though is, what about next year? This happened. I had something came up in this year, and I tell them, I'm sorry, I had some financial difficulties, medical problems, whatever. This happened, and they're going to immediately say, okay, we'll work this out with you, this taxpayer. But what are you doing for next year? They're going to want to make sure that issue doesn't happen again. But you can set up a payment plan with the IRS. So I think a Form 9465. You can file it with your tax return. It's pretty much automatic. If you owe under $50,000, you can tell them that you want to pay. I think they'll spread it over like 7 years. So you can take whatever you owe, divide it by 7. I divide it by 6 because they are going to continue charging you interest. And however little money that is, they're going to want to take it out of your account directly. You have to give them your bank account, but they'll pull that and they'll leave you alone. You won't never hear from them. They'll just start pulling that every month. So it's really easy to work with the IRS. But the IRS is charging interest. So maybe a credit card, if it has a lower interest rate, this is not tax, this is financial responsibility. Then you got to look at, hey, maybe I have a low interest, maybe I found this 0% interest credit card that I have, and I think I can pay this tax off in a year, then I put it on the credit card. But now you pay the IRS for the credit card, you're going to pay a credit card processing fee on the IRS's website. So you got to add that in too. There's also something called an offer and compromise. When there's a doubt that you can ever pay that tax, you can go through an offer and compromise process to try to actually change the tax. You're not saying that you necessarily disagree that in that year you didn't owe the tax, but you are saying, dear IRS, something changed. I was working. The last offer and compromise I did, I had a psychologist that was working. She got close to retirement. She had some tax liabilities when she was working. She retired. She got cancer. She was on Social Security. There was no way she was ever going to pay those back tax liabilities. She was going through cancer treatment. She was unemployed. She couldn't keep a job. And so we did an offer and compromise. And we told the dear IRS, this is the best we can do. They will work with you. Don't ignore the taxes because they will work with you. But going back to understanding why you owe, this is a common misconception, and it starts with a W-4. Is everybody familiar with the W-4? So if you're working as an employee, you're going to fill a W-4 out, and that's going to guide your employer how much federal income tax to take out of your paycheck. And I often have clients come to me when I tell them that they owe. They're quite upset, and they don't understand how they can owe because they told their employee to take out taxes. Their employer. How can they possibly owe? And what happens, in most cases what happens is, let's go back to these tax brackets and our little summary sheet. tax bracket. Well, let's say I've got two people working in this married filing jointly relationship, okay? And one of us makes $60,000, and I go to my employer and I fill my W-4 out. That's all great. But then, you know, my husband comes up and he makes $300,000. Well, my employer doesn't know my husband makes $300,000. I don't know that my husband makes that. I'm dreaming. But my employer thinks I make 60. And so based on me telling my employer that I make 60, they're gonna put me maybe in the 12% bracket. But my husband just pushed us into the 24% top bracket. And so come the end of the day, if I was to look at that tax return and you're gonna, I'm talking to the husband, I was like, well, it's your wife's fault. Well, really, it's your fault because you make too much and then you're making her, y'all gonna have to figure it out. But she didn't have enough to pay, but that's because you made too much. But that's a common issue. So the biggest thing here to tell you is that this is not the end all be all. Don't think that just because you fill this out that you're not gonna owe at the end of the day. Because it can happen. And it mostly happens when you have a two-income household and there's disparity between the two incomes. Because that can be an issue.
So what would you have one that would work in, like, say, for instance, I have.
There's actually a detailed calculation on the form that you go through. Usually what I do is a lot of times it's easier for me is when I have a conversation with a client, I'll sit down and say, look, you just make sure it just, you know, one was a federal employee, the other one was a local employee. I was like, okay, who's the easiest to deal with their human resource department? Sometimes it's a problem trying to get some of that changed. And I look at it and I say, look, if everything else stays the same, you probably need to have about $100 more a month withheld. And they'll go to their human resource department and just ask them to add $100 a month. That's usually the easiest thing to handle now. But that W-4 actually has a detailed calculation. It's just no one goes through it.
Question.
Yes, ma'am.
Well, why couldn't you just go ahead and file your own tax and let your husband file his?
That's a good point. You could, but that could end up costing you. Because again, let's go to these tax brackets. And we've been talking about the married filing jointly bracket, okay? So then you'd be using the married filing separately bracket, which are pretty much half, okay? But if there's a disparity in income, let's just say I made $10,000 and my husband made $300, okay? Well, what's gonna happen is my income's gonna be taxed at the 10% bracket. That's the bottom table, okay? My husband's income's gonna be taxed at the top rate of 32%. I didn't use my 12% bracket, I didn't use my 22% bracket, I didn't use my 24%. I didn't use my half of those brackets. But because I'm filing separately, my husband can't use my half either. But if I file jointly, he gets my half of the brackets that I don't use. So those are lower income rates, because our income's gonna jump through every bracket. Does that make sense? Okay. It's a good question. I would say 99% of the time, it does not make sense to file married filing separately. The exceptions to that, the one biggest exception is if one spouse has back tax issues and there's liabilities back there, then if you file jointly, the IRS will take any refund and grab it for that person's back taxes. When you may say, hey, this is my refund, and that tax has nothing to do with me, we were not married, the IRS doesn't care, we're looking at a joint return. So that's usually one of the reasons we wouldn't file married filing jointly, but it's usually a rare situation. What do you do if you haven't received your refund? I know these are links, I tried to type in the www and it just kept bumping back to a link. But no, if you type in IRS, where's my refund, or if you type in Georgia Department of Revenue, where's my refund, there's a nice little splash page. Put your social security number in, you put what your refund is in, and it'll give you some information about that. It'll tell you we've got your tax return, we don't have your tax return, your refund was deposited into your bank account, your refund check was mailed. It will give you that information. Sometimes it'll say we don't know anything about your tax return. And that's not an uncommon situation. But it's very easy to check. Now we'll tell you the state of Georgia. And I can't tell you how quick rhyme or reason sometimes. And with the state of Georgia, if you've moved, if something's changed on your return for some reason, you've moved, your name changed or something like that, I do see in a regular occurrence the state of Georgia is holding those refunds, and they're trying to protect them from identity theft. So sometimes it may say you need to call a number. And it's not that you've done anything wrong, they just want to verify that everything's right before they release that refund. Unfortunately, I don't see them sending letters out to say, hey, you need to do this. It just happens when someone says, where's my refund? A client calls me, and I'm like, oh, let me check, and I check, and it says you need to call, and they're like, well, they didn't send me a letter, I know if they didn't. So if you're not getting your money, you want to check with all of them. Questions? A couple of common issues in the states. We're going to talk about health insurance on the first one. Requesting direct deposits to an account that doesn't match the tax return. This, I think, is more of a banking information, but if you're filing a joint return, and then you have maybe just one of you has a bank account that's just one of you, and you decide, hey, this is where I want my refund to go, that might get kicked back. Again, that's more of a banking issue and not necessarily the IRS, because the bank is saying this is a joint check, this is a joint refund, and you're trying to deposit it into a single account. And so be careful about that. A lot of times newly married taxpayers, I was like, nah, you just have to get a paper check. Because I'd rather you get a paper check and it take an extra week than for us to attempt this to happen. It doesn't happen, and then the IRS has to figure out 6 months later that it didn't happen, so then we're talking a year for you to get your refund. Incorrect filing status. If you're married, you're married. Your choices if you're married are married filing jointly and married filing separately. Now there is an option out there if you're separated, if you're physically separated, not sharing the same residence, and there's certain criteria you have to meet, you may qualify as head of household. But in general, if you're married at the end of the year, legally married filing jointly, married filing separately. Unfortunately, on the flip side, if you have a spouse and they pass away on December 30th, you're single. And that's it's horrible. My mother, on the flip side, my father-in-law passed away on January 1st. His wife filed married filing jointly for that year. It's your status at the end of the year, calendar year. Claiming dependent is no longer dependent. That happens often. I used to see that when you file a tax return, because if I got somebody on my tax return that I'm filing for a client, and that person has already filed a tax return, I'm going to get an automatic spit from the IRS says, nope, someone's already filed that return. But I see that a lot of time. I'll call the client, oh, I forgot to tell you, they got married this year. And sometimes children just run out, and they got a W-2, and they saw that they had $500 in withholdings, and they run out, and they don't talk to their parents, and they file their own tax return to get their money back. And they don't know to not check, hey, I'm a dependent. Yeah, you're still a dependent. It wouldn't have changed your return anyway. You were going to get all that $500 back, and you just messed me up. Omitting income, again, all income, this is a good reason. Make sure you got all your tax forms. Because the IRS has got in their system what they think your tax return looks like by all these tax forms that have been sent to them. W-2s, 1099s. I often have clients that just sit there, oh, I didn't think you needed that. If it's a tax form, it goes on your tax return somewhere. It may not mean that it's going to impact your return, but it needs to be reported somewhere. And any credits that you might be eligible for. We'll talk about the 1098-T. That could be a credit. We want to make sure that, if you've got a child in college or whatever, there may not be any benefit there, but it could be. The IRS isn't going to come back and tell you that. If you leave off the 1098-T for education credits, the IRS is not coming back and telling you that you did that. And the last thing is not looking over your return as someone else prepared. Again, it's your return. Bottom line. This is just funny to me. I do a lot of farm returns. I grew up on a farm. I'm 6th generation farm family. And this has got a client's name on it, but this was family. But this is a 1960 tax form. And I just thought it was funny that you would have to put the quantity of, somewhere there's eggs on here, you have to put the quantity of eggs. There's syrup, S-I-R-U-P instead of S-Y-R-U-P, but you have to put the quantity of syrup. So this was
first one this year, so I know for a fact that it's one of the most informative sessions this year. And so again, I want to thank Amy for coming to share with us, and I certainly, it's just team a lot. This is the sign-in sheet for the two people that came in, so let's just scan that real fast. And then I'm gonna put the, evaluation code. I know we're gonna get some good evaluation. Yes, this is so, oh my God. I know it's also all fine about the self-employment thing, because I even wonder about, like, say for instance, with Mary Collins joined, because sometimes I wondered the same question. When do you know that it's good, not, I mean, but every time, the question always comes up, they always say, file Mary Collins joint. It just always, they always just say good. So,